Welcome everyone to Vested Interest. This is Shane, and today we are going to do something a little different. I actually have the day off for Juneteenth. It's the first time my company has had this holiday off. I think it's the first time for a lot of companies since it was just made a federal holiday. So I took advantage of that and I kind of just thought about what I would do if I was starting all over. What are some things I would like to know before I got into the market? And I put together some slides, some investment terms. Like it says on the screen here, I'm going to go over 10 investing terms. This is really for beginners. So if you're a seasoned investor, this might not be as valuable to you, but maybe there's some useful information in there. So check it out. And the biggest thing, guys, is getting started. As you can see here, Investing 101, that's the first thing. Getting started. Everyone can make 1,000 excuses why you can't get started or why you shouldn't get started. Afraid of losing money, don't have the money, owe debts. There's 1,000 of them, but the biggest thing is to get started. And if I was to get started all over again, I put together some things I would like to know. So let's jump right into the video. So we're going to go over capital, assets, stocks. Obviously, that's what we do here on this channel. We invest in dividend growth stocks, brokerage account, stock market and stock exchange, intrinsic value, margin of safety, price to earnings ratio or PE, earnings per share or EPS, ROIC or return on invested capital, and DCA or dollar cost averaging. These are some things I wish I would have known in the very beginning, some simple terms, some standard practices, so to speak. And if you had just a foundational view overall of each one of these, I think that would give you a good foundation to start from to get investing, to be able to dip your toe in the water, so to speak, and maybe take some of the fear away, the fear of the unknown. And again, I think if you understood these terms and these investing, let's say foundational investing principles, then you would probably have a good basis to start from. So let's jump right in. Capital. Capital, simply put, it's anything that has value. I pulled this up. This is actually from a caption of a video, History Illustrated, historyillustrated.net. This is actually for kids. It's a video, so if you wanted to pull this up and share it with your children, I would definitely recommend it. It puts it in very easy, simplistic terms. Again, so capital is anything that has value. It's property, gold and silver, cash. Mostly we'll be talking about cash, the cash that we are going to utilize to buy assets. Right, we want to take our cash that we've earned and we want to turn it into assets, right? It's also buildings, furniture, gems, businesses if you own businesses. So anything that has value, that's what capital ultimately means. And again, with that cash, with that capital, we want to buy assets. What are assets? Assets are things we own. They're not liabilities, much different than liabilities. So it's cash, it's stocks, it's computers, buildings, furniture, investments, accounts receivable, cash equivalents, machinery, and then it's the opposite of liabilities. The things we don't own are liabilities. Payroll, if you own a business, your payroll is at dividends. When a company pays out a dividend, it is actually a liability to them. Accounts payable, loans, if you have loans, a car loan, a house loan, until you pay it off, it's not an asset. So if you own a house, right, you might think, well, I have an asset. Well, if you have a loan against it, it's actually a liability. Once you pay it off, then it becomes an asset. Or if you have equity in your house, your equity in the house would be an asset. So if you own a $800,000 home, for example, and you've paid it down and you've got $300,000 in equity, so you only owe $500,000, that $300,000 in equity would actually be cash. You could pull that out in cash, so that would be considered an asset. Credit cards, that's one of the worst liabilities to have. Hopefully you're not living on credit card debt. Utilities, also liabilities. I know we all have to pay them. We want to keep the lights on, keep the water running, but it is a liability because it's a recurring cost that you continue to pay. So it's all payable. The liabilities, we don't own them. We have to continue to pay for them. Services, those are liabilities. What we're really looking for is assets. We want to take that capital, that cash, and we want to buy assets like stocks, real estate. Primarily on this channel, we focus on stocks. And then what do we want to buy? Again, if we want to buy assets, we focus on this channel on stocks. And what is a stock? A stock basically gives you part ownership of a company. Companies that we look at on this channel, on Vested Interest, we look at dividend paying companies, right? So they are limited, your limited liability. You don't, if the company goes bankrupt or owes debts, you aren't responsible for those debts. You're just a shareholder of the company. You get price appreciation, you get potential voting rights. However, there are some risks. You can risk losing your investment, right? Your capital that you put in there to buy the stock. But when a company does well, so do you. You get that price appreciation. You also may get those dividends if it's a dividend paying company. Again, we focus on dividend paying companies here. So again, we've got capital, that cash. We want to buy assets. We want to buy stocks. We want to turn that capital into assets, not liabilities. And in this channel, we focus on stocks. And how do you do that? How can I buy stock? Well, in order to buy and sell stocks, you'll need a brokerage account. This account allows a broker to sell and purchase on your behalf to other people willing to give or take the same stock. So you, as the person, you have that capital, that cash, you want to buy stocks, so you open a brokerage account. I use Ally Invest. That's my main brokerage account. I also use Webull. There's a Webull link down below. If you want to open your own brokerage account, go ahead and use that link. You'll get some free stocks. I'll get some free stocks. It's a way you can help the channel, and it gets you into the investing game. You have to have a brokerage account to be able to purchase stocks. Take that capital, that cash, buy assets through your brokerage account, purchase the stocks. So that gets you started once you open the brokerage account. Most brokerage accounts, I know it says that there's some fees down here, instructs the company to trade in shares or bonds on his or her behalf. You can buy bonds as well, ETFs. Again, we focus on single company stocks, but ETFs are a way to go as well. Some brokerages take money, they deduct money from your capital to make the trades. Most brokerages these days don't charge you anything. If they are, you should look for a different brokerage account. Next, where are we going to buy those? Well, we're going to go to the stock market. The brokerage account is going to go to the stock market. What are they? They, again, buy stocks or bonds in the market, and often called the stock exchange. What is it? It connects buyers and sellers, right? That's where stocks are sold, is the stock market. You can also have bear and bull markets. Bear market is a declining market investing. You should be cautious. We're in a bear market currently. Or you have a bull market, which is what we had been in until we were in this recent bear market. You have a bull market. Economy is strong. Stocks are going up. Investors are aggressive. They're sinking money in, and actually sometimes get too aggressive. They create bubbles, which is what we have. So companies sell stocks. Why do they sell stocks? They raise money to grow, reinvest back in the company. Again, you're the buyer. You want to find a seller. You want to buy stocks. The exchange process, the brokerage will work with the exchange to process your payment, list the stocks, Apple, Microsoft, Yahoo, whatever stocks you want, and they track the prices, sales data, so you can look at the stock exchange, New York Stock Exchange. There's many stock exchanges around the world, Korea, Japan, they all have stock exchanges as well. Where New York Stock Exchange, NASDAQ, so what different exchanges where you can buy different stocks. We mostly buy on a New York Stock Exchange. I would say in the NASDAQ, S&P 500, these are all exchanges. This is all brought to you by napkinfinance.com. If you wanted to see some more graphics like this, I think they're very informative. But that's the stock market and the stock exchange. That's where you're going to buy stocks. Again, you want to take that capital, buy assets. In this case, we want to buy stocks. You do that through your brokerage account. The brokerage account goes to the stock market, the stock exchange, and buys those stocks for you. They find a seller, and you purchase the stocks. So how do you know what to buy? This is one that I think a lot of people really need to bear down and understand. There is, according to Warren Buffett, intrinsic value. So when you look at a stock, you want to estimate or find the estimated intrinsic value. What is intrinsic value? Intrinsic value can be defined simply. It is the discounted value of the cash that can be taken out of the business during its remaining life. The calculation of intrinsic value, though it is not simple, as our definition suggests, intrinsic value is an estimate rather than a precise figure, and it is additionally an estimate that must be changed if interest rates move or forecast or future cash flows are revised. So intrinsic value is basically a snapshot in time. It's looking at the future cash flow, all the cash that the company is going to generate into the future. it's looking at current interest rates, it's looking at the current debt, and it's saying, okay, the business based on the profits, the debt to equity, all this information that we bring in, it tells me the company is worth X, whatever that X is, $5, $10, $100,000, $500,000, $1 billion, $1 trillion, whatever that company is worth, that is the intrinsic value. Once you figure out the intrinsic value, and that's based on, again, the debt, the profits, how much the sales of the company are making, all that. Once you get the intrinsic value, then you really just divide that number of the company, the intrinsic value of the company, let's say it's 500 billion. You divide that by the amount of shares outstanding, right? So 500 billion divided by 100,000 shares, and then whatever that price is, that will tell you what you should pay for that stock at that time. And so long as nothing changes, that should be the value of the stock, free cash flow, all that should come into play whenever you're looking at the intrinsic value. And then you say it's worth this, and I'm not going to pay any more than that. So as you can see here, a Warren Buffett calculator, and there is you can go online and find calculators for intrinsic value, discounted cash flow models will give you that as well. That's what I use, a discounted cash flow model. And this is the intrinsic value. If it's below, right, if the price of the stock is below the intrinsic value, you want to be buying it. If it's up here higher than the intrinsic value, you want to lay off, unless you have bought it so low where you can buy it up here and it doesn't raise your cost per share above the intrinsic value. You don't want to pay more overall than the intrinsic value. So once you start earning shares of a company, it may go up. Again, if you've bought it so low that you can overpay a little bit and it doesn't raise your cost per share above the intrinsic value, that's great. But as soon as you start going, your cost per share starts going above the intrinsic value, you should stop buying and wait for it to fall back to or below intrinsic value. So intrinsic value is very important. There is a value to stocks. Just because they're the next big thing, going to be the next great company, they're the future bro, whatever terminology you want to use out there, there is a value you should pay for every company's stock, and you should not overpay. Overpaying increases the likelihood that you will have little to no returns in the future, and that your capital that you put into play will not be working for you, which is not what you want. You want to put capital to work and get a good return, not just the dividend, but also some market appreciation, stock appreciation. So the cheaper you can get it, the more under the intrinsic value, the more upside you'll have, and the more return on your invested capital. So again, understand the intrinsic value, know what the stock is actually worth before you buy. And then once you know that intrinsic value, build in a little bit. Here's your intrinsic value. And again, as things change, intrinsic value may change. It may go up, and hey, it may go down a little bit. That's why you might want to build in a little bit of a margin of safety. What is the margin of safety? It is calculated as the difference between the sales or production unit, so the intrinsic value, at the selected activity, and the break-even sales or production. Margin of safety is the difference between the total sales, actual or projected, and the break-even sales. It may be expressed in monetary terms value or as a number of units, stocks, shares, that's the number of units. A large margin of safety indicates the soundness and the financial strength of a business. So if you've figured out the intrinsic value, okay, the stock is worth $50, for example, and you want to buy it for 10% less than that. That's your margin of safety. So I'm not going to buy this stock. So I think it's worth $50, but I really want to build in a margin of safety of 10%. So $50, 10%, that would be $5 off of that. So you would want to buy it around $45. That would be your buy zone. So it's worth $50. You say, I may be off a little bit. My estimate may be off, or the company next quarter might be slow, or sales might slow down. So I want to build in 10% safety. Then I'll buy it for 10% less than the intrinsic value. So build in that margin of safety. Then you're guaranteeing yourself that you're paying less than what the stock is worth. This is, again, one of those ones I don't think enough people really understand or take into account whenever they are buying stocks. Understand the intrinsic value, what's it actually worth, build in a little bit of margin of safety. What the margin of safety is, that's up to you. Maybe 5%, 10%, 15%, whatever you're comfortable with, 12%. I usually do, depends on the stock. If it's a stock, with a lot of growth, I might use 5%. If it's a stock that is what they call a blue chip stock that's been around, it doesn't have a lot of future growth. It's just something, like General Mills or Kellogg's or something like that. Not a lot of growth in those companies. They're well known, they're established brands. They're going to continue. People who are buying Kellogg's are going to continue to buy Kellogg's. People who buy General Mills are going to continue to buy General Mills. Kraft Heinz, those things, they're slow. So you figure out the intrinsic value. I might only use a 5% margin of safety. A company that's really, like I said, growing, or sorry, I might use a larger margin of safety for something that's not growing as fast, maybe 10%. Something that's growing really fast, I might use only 5%. You know, an Apple, Microsoft, something like that. I might use a lower margin of safety and be willing to pay closer to the actual value of the company. So find your intrinsic value, build in that margin of safety, and that's your buy zone. Now, another thing you want to look at when you're looking at stocks is what we call PE ratio, and you want to understand what is PE ratio. PE is just price to earnings, right? So it's price to earnings ratio, often called the PE, can be calculated only for listed company, is the ratio of company stock price to the earnings price. So right here is a simple formula: market price per share over the earnings. So you have to know what the earnings are actually and how many shares there are of the company. Benefits of understanding the PE ratio: it helps investors analyze how much they should pay for a stock on the basis of its current earnings, and also shows the market is overvaluing or undervaluing the company. So a few things to look at for PE. You can look at the sector PE, right? So you might have let's say consumer staples, a company in consumer staples, which is what we were just talking about, companies like General Mills, Kellogg's, Kraft Heinz, Campbell Soup. Those are all in consumer staples. So you could look at the average PE for consumer staples and kind of see if General Mills is the average, or I'm sorry, if the average for consumer staples is, you know, let's say 13, and General Mills is at a 15, well, it's above the average, right? Or if it's below 13, let's say it's 9, 10, well, then it would be below. So that would be a indicator that it would be either overvalued or undervalued based on the sector average. Again, right, what does a high PE ratio mean? The stock prices may be overvalued or the company is growing rapidly. So sometimes you have high PEs because they expect much higher future earnings. A lot of tech companies, for example, tend to have higher PEs. And what does a low PE ratio mean? The stock price may be undervalued, or the company is in a mature industry and it's not growing as fast. So PE is one that I think everyone should understand. And then earnings per share. Since we looked at PE, which is price to earnings, we should also understand what earnings per share would be. So the earnings per share, you can look at it a couple different ways. Net income of the company divided by the average outstanding shares of the company. So how many shares does the company sell? And what is the net income? Divide that, and that'll give you the earnings per share. That's for non-dividend paying companies. If it is a dividend paying company, you'd go net income of company minus the dividend to preferred shareholders and divide that by the average outstanding shares of the company. So price to earnings, earnings per share, you should understand. Those are two important ones. There are others, obviously. This is another one that I like to look at. It's called ROIC, return on invested capital. ROIC stands for return on invested capital and is a profitability or performance ratio that aims to measure the percentage return that a company earns on invested capital. So it's basically the money that the company reinvests in itself, whether that's in, you know, new equipment, automation, buying other businesses, buying out competition, buying back stock. What is it doing with the money that it's investing? You could look at that in a lot of different ways. You know, expanding, buying new real estate to expand to another manufacturing plant, building a manufacturing plant. That's all invested capital. What are they getting out of that capital? If they're spending $1,000, here you can see a net operating profit after tax divided by invested capital. That kind of gives you the overall calculation for it. Return on invested capital is calculated by taking into account the cost of the investment and the returns generated. You want companies with a high return on invested capital. Returns are all the earnings acquired after taxes, but before interest is paid. The value of an investment is calculated by subtracting all current long-term liabilities, those due within the year, from the company's assets. The cost of investment can either be the total amount of assets a company requires to run its business or the amount of financing from creditors or shareholders. The return is then divided by the cost of the investment. So again, looking for low PE companies with high return on investment. And then once you know these things, right, you've got your cash, you want to buy assets. In this case, we want to buy stocks. You've got your brokerage account opened. You've figured out the intrinsic value. You've figured out your margin of safety. You've looked at the price to earnings. It's below value, or you feel it might be undervalued based on that metric. The company has a high return on invested capital. It's making good earnings per share. Then what do you want to do? Well, you want a dollar cost average into that. Don't drop your whole, you got $15,000, maybe drop 4,000 in, and then see where the stock goes. If it goes down, then you could drop another 4,000 in. And what I would do is just kind of the same amount over time. So dollar cost averaging, an investment principle of buying a fixed dollar amount into a particular investment on a disciplined, regular basis. That's the most important part there. Disciplined, regular basis. Consistency is key. I do $1,200 to $1,300 every week. I know that's high. I'm a high earner. We've pretty much based all of our lifestyle on my wife's income, and then everything I make goes into investments. That's why I invest so much. It's pretty much everything I make. Not everything I make, but about 70% of what I make goes towards investments. The investor purchases more shares, units when prices are low, and fewer shares when prices are high. So this is one of those ones we were talking about earlier. Whenever you're in, the intrinsic value, whenever it's below intrinsic value, hey, be buying those shares of that company. If it starts creeping up above intrinsic value, then you want to look at your cost basis per share. If your cost basis per share still allows you to continue to buy it, and it's not above intrinsic value yet, then you can continue to buy a little bit, but don't go crazy. And then as your cost per share reaches intrinsic value, then you want to back off and stop buying. Regular deposits at regular time intervals, for example, $50 per month, $50 per week, $50 per year, whatever you can afford, just make sure it is consistent, disciplined on a regular basis. And what it does is it avoids trying to time the market, and it takes the emotion out of investing, right? You're not worried about, oh my God, I'm going to miss something. Nope, just continually dollar cost average into the stocks that you want to buy over time. And really, those are the fundamentals. So again, let's quick recap. You want to take your capital, in this instance cash, you want to turn it into assets, that's stocks. So you want to buy stocks through your brokerage. You want to find the intrinsic value of the stock. What is it actually worth? You want to build in a little bit of margin safety. You want to kind of look at some metrics like price to earnings, price to earnings ratio, with PE. You want to look at the return on invested capital, and then dollar cost into those averages. And the last thing I'll really leave you with, guys, here, this is another Warren Buffett kind of saying. He'll say in the short term, the stock market is a voting machine. In the long term, it's a weighing machine. So understanding, if you want to be a long-term investor, which is what I am, you want to understand company fundamentals, and you want to understand what its market value is. If you're a trader, you're looking at short-term trends, right? What's trending now? What's the next new thing, right? The news. And that's a voting machine. Is everyone dumping their money in because, we're a fear of missing out, like Tesla investors? Tesla's going to the moon, I better jump in or I'm going to miss it. Well, that's short-term, that's a trader mentality, short-term mentality. We want to have a long-term mentality based on market values and company fundamentals. We want to be a weighing machine, because over time, the short-term, everything feels good, they are going to be weighed out, and a lot of times they're going to be the stocks that lose significant amount of value, because as things turn like they are now, interest rates go up, stock market volatility goes up, Fed rates go up, all the other rates associated go up, and we enter into recession. Well, then you're going to find out what the company is actually worth, what its value is actually worth based on fundamentals. So I know this might have been a lot, but these are some things I wish I would have known early on. There are 10 really of the terms that I think you really want to jump into. Again, capital, assets, stocks, brokerage account, intrinsic value, margin of safety, price to earnings ratio, earnings per share, how much company the returns on investment, or ROIC, return on invested capital, and dollar cost averaging. And if you understand those, you obviously want to continue to do more research, and the more you understand and the more you can research and understand, the better investor you will be over the long term. But these are some ones I wish I would have known early on that I didn't really understand. Probably got into some stocks that I shouldn't have. And hopefully you can learn from my mistakes and get your foundation, your base set, and then go from there. Hopefully this was informative. For any of you investors out there who are a little more seasoned, if you have some other suggestions, comments, things I didn't cover in that, I know it was a quick one. I'll probably do another one similar to this, but this one I thought was a good one to get the newbies out there, some of the newcomers out there who maybe are on the fence about investing. And as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit the thumbs up, ring the notification bell, subscribe to the channel, drop a comment down below. Let me know what you think. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, suggestions for future videos. Constructive criticism is welcome as well. This is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, we'll see you next time, guys. And remember, first step. Get started. That's the number one thing. Get started investing. Don't make excuses. Just do it. The only way to reach financial freedom and financial security is to buy assets. Turn those fiat dollars into assets as quickly as possible. In this channel, we cover dividend growth investing, stocks that pay dividends, that grow over time, so that one day we can utilize that passive income produced by the stocks, produced by those dividends, to live off of or to invest into other assets. That's the key. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money and should never invest any amount you're not comfortable losing. Always do your own research and invest based on your situation, circumstances, and select criteria, or seek the advice of counsel of a certified financial advisor.